Dan, that's a great point to bring you in. And, you know, as you've said, like the conditions are in place. The market is incredibly receptive right now. We have stocks just almost at frothy levels. So this would seem to be a great time to go public, except that things were so much frothier in the fundraising world, whatever you want to call it, back in 2021.
It was. I mean, look, the conditions have been good for 2 years now. You know, if we went back even 12 months from now, we would have been talking about IPOs for companies like Instacart and Klaviyo, et cetera. And there was a ton of stories. I think I wrote some of them. You guys probably covered them, which was the IPO market is, you know, opening up. It's going to be great in 24. And then it wasn't. And by the way, we heard that at the end of 23 also. And some of those ones Bob pointed out that have gone public this year, Reddit, Rubrik, et cetera, they not only priced well, they have traded well in the aftermarket. Look, there has been a combination of cowardice among venture capitalists and venture-backed founders. As Bob said, there is plenty of money still in the private market to do tenders, et cetera. And also, I think the bankers maybe have misread the market. I mean, there's two ways to read the ServiceTitan thing. One is, wow, look at ServiceTitan. Another is to say the bankers were wrong here. They were wrong with the original pricing. They were wrong with the amended pricing. Now, there's questions about a little bit of conflict of interest among ServiceTitan's own VCs, as Leslie points out. Some of those folks that had that compounding ratchet probably wanted it to price lower. Questions, did they put some pressure to get that to happen? But, you know, bankers are telling founders, you know, the market's not ready. The market's not ready. The market's ready. It's been ready.
And it's weird, Dan, because venture capital is it's such a nadir right now. I mean, they are struggling for exits. We've seen a lot of funds shutting. I'm surprised they're not more desperate to say, just get the thing out.
They should be. There's been this trend for about 5 or 6 years, or maybe even longer, 10 years now, of founder-friendly venture capitalists, right? Like venture capitalists used to be viewed very skeptically by a lot of founders because they came in there with sharp elbows, and then they went in the other direction. They really overcorrected. So VCs don't like to push their companies public or push them to do anything. But you're right. You know, the startup cycle, and I wrote this today in Axios Pro Rata, the startup cycle only really works if venture capitalists invest, and then those companies, the successful ones, return a lot of capital so that the venture investors' own investors reinvest. Yeah. That's not happening right now. There was a survey of limited partners in venture capital funds that came out just a couple days ago. 80% of them said they had not reinvested in at least one of their relationships over the past year, and a majority expected to do the same this upcoming year. That's all because of a lack of distributions.
And Bob, what you wrote about this in your column as well, that's meant even the IPO ETF has like half the holdings it used to because there's been so few companies coming to market. 32. And this is a larger trend where, you know, someone's had the data lately. You go back 20 years, there were way more publicly than privately held companies in this country, and that's now completely flipped.
So I'll tell you something that's, yes, there's 32 companies in the IPO ETF. There was twice as many 2 years ago. So I'll tell you something, besides the money issue, the fact that companies are essentially getting paid to stay private at this point, I want to see what the SEC has to say. We're going to have a new SEC chair coming in. The nomination is Paul Atkins. They have talked in the past about making it easier for companies to go public. There may be something to do on the regulatory side, because other than the fact that they're getting money thrown at them, the tech companies, to stay private, people complain, companies complain, it's too difficult, it's too onerous, it's too much lawyers. Is there some way, could the SEC look at some way to make it a little bit easier for companies to go public without dropping the proper regulatory scrutiny? I would like to see the SEC make that a major issue for 2025. Remember, we had the Wilshire 5,000 years ago. There's only about, 3,500 companies in the Wilshire. It's getting smaller. Why? It shouldn't be. Why are our viewers missing out on the chance for to be involved in young companies? Why are companies middle-aged going public that have been around for 10 or 15 years? It's wrong, and we need to find a way to address that.